Hello, I'm Bernard Hickey from interest.co.nz and welcome to an interest rate special, in particular a monetary policy special. That's because monetary policy is now a political issue. Just a few days ago we had consensus between the major parties, and a consensus that had lasted 20 years. That consensus was around the Reserve Bank targeting inflation as its sole focus. That's been going since 1990 when the Reserve Bank Act came into force. Firstly, it was Don Brash as the governor then, and now it's Alan Bollard who have been targeting inflation. Currently that target is 1 to 3% inflation. Now we have Winston Peters coming out and saying that the Reserve Bank should target exports and growth, maybe unemployment, as well as inflation. Essentially he's saying interest rates are too high, it's hurting exporters and it's hurting borrowers. Now the Labour Party, Trevor Mallard in particular, have come out and said, well yes, maybe Winston Peters has got a point. Maybe we should look again at the Reserve Bank Act. This is a major development. This says that political consensus, which meant monetary policy wasn't a political football, has broken down. And it is now a political football. That means whenever Alan Bollard makes a decision about interest rates, we'll all ask the question, was he bullied into it by the Finance Minister? Or is the Finance Minister just about to complain about his own central bank governor? And that's important because now we are dependent on foreign investors. Essentially, they've got us by the short and curlies. And we should care what foreign investors think, because our debt servicing costs are rising fast to levels that we were at in the late 1990s, just before our currency collapsed. And you can see here our level of overseas debt. It's high and it's been rising sharply for the last 4 or 5 years. We now have over 120% of our debt as a percentage of GDP. That's up very sharply. And if you look at this chart here, and it's very interesting, you can see that for every dollar that we earn in exports, we have to spend 17 cents, 17% of that dollar, to pay just for the interest on that debt. And that's risen very sharply, almost doubled in the last 4 to 5 years. And you can see here with this combination of these two charts, that debt servicing ratio and the New Zealand dollar are very closely linked. Essentially, when foreign investors work out that we've borrowed too much and that our debt servicing costs are too high, they stop lending to us. In fact, they might even pull some of that money out. This is important because now our banks owe foreign investors over $100 billion. And about $60 billion of that debt is rolled over every 90 days. So just imagine if you had a mortgage and the bank came to you every 3 months and said, we might want our money back, or I'll roll it over now. That's how our banks feel every 90 days. Foreign investors come to them and say, we'll decide to let you keep the money this time around. $60 billion, that's the equivalent of $15,000 for every New Zealander. So what does this mean? This means our currency is vulnerable to a big slump. And as we saw in the late 90s, that's what happened when our debt servicing costs got too high. And what does this all mean? This means foreign investors who care about our monetary policy will now have to care about political opinion polls. Now currently right now it's unlikely monetary policy will be changed. There just isn't enough time before the election. But if Labour were to get back in, or if foreign investors started to sense that Labour might get back in, they would know that interest rates are going to be lower than would otherwise be the case. That puts pressure on our New Zealand dollar. And there is a real risk now that foreign investors, if they see the chance of Labour getting back in, will hit our currency very hard. So what does this all mean? We're going to have a monetary policy debate. And it's worth asking the question, who's going to be in the respective corners? So let's look at it this way, the blue corner and the red corner. In the red corner, we have exporters and borrowers. Exporters, of course, would love a low dollar and would love low interest rates, as do borrowers. Borrowers have about $170 billion worth of debt at the moment, and exporters earn about $50 billion in export receipts every year. So that's a total of about $230 billion in the red corner. Now in the blue corner, we look at savers, people who depend on high interest rates for their returns and don't want inflation because inflation erodes the value of those borrowings. And then we have importers who of course like a high dollar. And they import currently around about $52 billion worth of imports. So in the blue corner, $150 billion. To give you a sense then, if it was a level playing field, The red corner would win at the moment if you went by the size of the assets and the debt that's behind them. I personally hope the savers and the importers win, because that will mean we've kept inflation under control. And for the long term of any economy, we need inflation under control. I'm Bernard Hickey. That was a monetary policy special for interest.co.nz.